Silver didn't go anywhere this week, but that doesn't mean nothing happened. What we saw wasn't calm, it was tension. Silver didn't trend, it lashed out. Sudden swings, sharp reversals, no follow-through. Not because traders panicked or emotions ran hot, but because a deeper realization started spreading through the market. This is no longer about how low the price can be pushed. It's about who still has access when supply tightens. Over the last several sessions, silver behaved like an exposed wire. Margin changes surfaced. Export controls entered the conversation. Quiet rumors circulated about industrial players paying mines up front. None of this was random. Every signal pointed in the same direction. The market is transitioning from a price game to an access game. This is your daily metals briefing. No hype, no filler, just the signals that actually matter. And here's the truth most people still avoid saying clearly. This isn't a volatility story. It's a sovereignty story. When markets are purely speculative, they look obvious, loud, chaotic. Everyone chases momentum. Volume explodes. Narratives go viral. It feels like a casino floor, bright lights and noisy crowds all fighting for the same chip. But when a market becomes strategic, the behavior changes completely. The action moves off the screen. It shows up in policy drafts, compliance language, private contracts, quiet phone calls, and agreements that never hit public exchanges. That's what silver is starting to look like now. Yet the headline crowd keeps making the same mistake. They treat silver as small, insignificant, easy to bully. They glance at the futures tape, see erratic price action, and laugh it off. That's a serious misread. Silver isn't small. Silver is thin. And thin markets don't absorb shocks. They fracture. Think of silver as a narrow bridge stretched over a canyon. The strength of the material doesn't matter if the bridge was designed for light traffic. Push a stampede across it, and it doesn't flex. It snaps. That stampede is forming. Industrial demand is not optional. Solar installations don't slow down because charts look bad. Electronics manufacturing doesn't pause because sentiment turns negative. Defense procurement doesn't cancel orders because social media gets noisy. When demand doesn't blink, supply becomes the only variable that matters. Who controls it? Who can secure it? Who gets cut off first? This is where Latin America becomes central to the story. Silver production in that region almost never comes alone. It's extracted as part of a bundle. Silver alongside copper, lead, zinc, a cluster of metals that modern industry depends on to function. These aren't luxury inputs, they are foundational. That's why this situation feels larger than a single commodity. Because it is. Silver is simply the easiest doorway to look through. Behind it sits an entire hallway of critical materials that power energy systems, electronics, infrastructure, and defense. Here was the unresolved question most people ignore while they argue over short-term charts. If supply chains in Latin America come under pressure, what else tightens with them? Hold that thought, because the geopolitical wiring behind it is messy. We're seeing export controls discussed in the same breath as margin adjustments. That combination is not normal. Margin changes are market tools. Export controls are state tools. When those two begin to move together, you're no longer watching price discovery. You are watching political discovery. And the most sensitive wire in this entire system is Taiwan. This is where many analysts hesitate because it forces them to connect dots the media prefers to keep separate. But the connection is real. Resources aren't just materials. Resources create leverage. Leverage builds influence. Influence shapes alignment. Alignment buys legitimacy. And legitimacy buys time. Time is the one asset every major power stockpiles when red lines are involved. If you understand how diplomacy functions at multilateral levels, you already know this. Latin America isn't just about mines and ports. It's about trade corridors, security relationships, voting blocks, public positions, and quiet assurances made behind closed doors. Countries that sit on critical deposits also sit inside political groupings that matter. They influence narratives. They decide who gets access and who doesn't. So when stress shows up in silver supply chains tied to Latin America, this isn't just a commodity signal. It's pressure building on a broader chessboard. And when that chessboard shifts, Taiwan stops being a headline and starts behaving like a clock. Now let's look at the warning signals already visible. First, volatility that doesn't behave like speculation. In speculative manias, participation explodes. Volume surges. Everyone wants exposure. The story goes mainstream. People brag about entries. This environment feels different. It feels like professionals trying to hedge something they can't model neatly. The moves are sharp, controlled, and defensive. Second, inventories that fail to reassure. When stockpiles are healthy, volatility gets absorbed. When buffers thin out, volatility becomes a flare. Silver has been running on tight physical buffers for a long time. That matters. Because when buffers disappear, paper markets can continue trading while physical markets start rationing. And once rationing begins, price stops being the primary signal. Third, direct prepayments. When large industrial buyers pay mines up front, they aren't chasing a better entry. They're securing oxygen. That's not speculation, that's survival planning. And once one major buyer does it, others follow. Because no company wants to announce a billion-dollar facility only to later admit they can secure the necessary inputs. Now layer in the corporate thread that many people misunderstood. In Asia, commentary surfaced about a major technology manufacturer being back. Markets cheered, shares jumped, analysts framed it as a feel-good turnaround. But buried inside that optimism was the real story. Next-generation memory, advanced hardware, and a pipeline of battery technology that changes charging behavior. Forget hype. Focus on mechanics. If batteries charge faster and safer, adoption accelerates, infrastructure adapts, energy systems get rethought, and demand for conductive and specialty materials shifts. When China explores new applications involving silver in charging systems, that isn't curiosity. It's a demand vector, another structural mouth at the table. So ask yourself something uncomfortable. If silver demand becomes structural across energy, transport, and defense, who gets priority when supply tightens? Retail investors clicking buy, or governments and corporations that can sign contracts, influence policy, and redirect flows? That's the strategic shift. And it's why daily price chatter is mostly a distraction. Screens can display any number. They cannot manufacture metal. We're not here to gamble. We're here to measure. So bring this back down to the tape, because the tape is revealing stress. Silver has been respecting technical levels more cleanly than usual. That's unusual for this market. Gold often trades like fog. Silver usually trades like a knife fight. Yet recently, silver has drawn clear lines and repeatedly honored them. That suggests something important. Large players are using levels deliberately, not casually. When price gets pushed through a level and then quickly reclaimed, you're watching liquidity probes. Stops get triggered. Inventory gets absorbed. Price snaps back. That isn't randomness. That's extraction. And when reclaimed levels hold longer, the message is even clearer. Stronger hands are willing to defend higher ground. The market is conditioning participants. Hard sell-offs shake out weak holders. Price stabilizes higher. Then the cycle repeats, like a spring compressing and releasing, storing energy each time. Most people get trapped staring at short-term charts, mistaking noise for signal. Sometimes charts are just mirrors reflecting stress elsewhere. So the real question becomes, what would actually change the story? Not sentiment, not opinions. Real catalysts. Credible peace progress would cool risk. Meaningful tariff de-escalation would do the same. But if prices dip while tariffs harden, export controls escalate, and Latin America becomes contested terrain, that dip isn't relief, it's a trapdoor. Because the conflict isn't fading, it's being formalized. Mexico floating tougher tariffs on China is a good example of how this conflict is expressing itself. That isn't a routine trade adjustment, it's influence friction. Old doctrines wearing modern language. And silver sits right in the crosshairs, because it lives where industrial necessity meets supply chain leverage. But if you really want to understand how fast markets can turn into history, you have to look beyond silver and watch oil. Oil is the heavyweight. Energy is the universal tax. Higher oil prices don't just affect one sector. They ripple through transportation, food, manufacturing, and logistics. Everything moves more slowly and more expensively. Now push the logic one step further. If one major power benefits from discounted energy because it keeps its factories competitive, do you think rivals are willing to allow that indefinitely? Of course not. Pressure builds. Counterpressure follows. Accidents happen. Headlines appear that look disconnected until suddenly they're not. That's how escalation actually works. It doesn't start with fireworks. It starts with incentives shifting. Slowly, then all at once. Now here's the line we always need to state clearly because we manage risk, not narratives. This is educational, not financial advice. We don't predict. We condition. We observe behavior. And the tells are already visible. One of the loudest tells has been hiding in plain sight. Gold has been rising alongside silver. The pairing matters. If silver were just a speculative trade, gold wouldn't necessarily follow. Gold doesn't chase excitement. Gold reflects confidence, or the erosion of it. When gold moves in step with silver, markets aren't just pricing a supply imbalance. They're pricing uncertainty at a broader level, a confidence imbalance, and confidence is fragile. Once it cracks, governments don't calm markets with press releases. They respond with policy. That's why the conversation around export controls matters so much. Because the moment controls become real, repricing doesn't happen in percentages. It happens in regimes. A commodity stops being treated like copper and starts being treated like a strategic asset. And strategic assets don't trade freely. They trade like energy, like semiconductors, like security infrastructure. Now close the remaining loop, Taiwan. If you're wondering how Latin America ties back to Taiwan, the answer is simple and uncomfortable. When competition tightens, every vote matters, every port matters, every shipping route matters, every long-term supply commitment matters. If a country believes it could face future restrictions or conflict tied to Taiwan, It doesn't wait until the crisis is visible. It secures what it can in advance. That means financing overseas projects, locking long-term offtake agreements, building redundancy into logistics, diversifying routes. Because if a choke point becomes contested, you don't want to be negotiating supply. You want supply already spoken for. That's what strategic behavior looks like. Quiet preparation followed by loud consequences. And it explains why silver can look irrational on screens while being perfectly logical underneath. So let's get practical. If you're watching this briefing, you were probably asking the same question many in our community are already whispering. If silver is being pulled into a resource contest, what does that actually mean for us? The answer starts with discipline. We separate facts from interpretation. Facts. Volatility is elevated, policy language is escalating, industrial demand remains sticky. Latin American supply chains are under geopolitical focus. Interpretation. The market appears to be transitioning from price-based competition to availability-based competition. That shift carries different risks. If tensions ease meaningfully, some of the premium embedded in prices can unwind quickly. That's a real possibility. But if tensions harden, availability becomes the dominant story, and paper pricing can lag physical reality by a wide margin. So what do we watch first? We don't watch opinions. We don't watch social media sentiment. We watch confirmation, firm export actions, not speculation, increased reports of prepayments and long-term offtake agreements, tariff escalation spreading across regions, energy policy shifts that affect cost structures, and most importantly, physical signals, premiums, delivery delays, allocation language, inventory terminology. When dealers and refiners start speaking like ration offices, charts become theater. Here's a question worth sitting with. If the paper price falls but physical premiums refuse to move, which one is lying? The screen or the shelf? Your answer to that determines whether you react emotionally or strategically. Here's another one. Is this really about a metal or is it about a map? Because silver is rarely the final story, it's the first alarm. Before we close, we need to address the emotional trap baked into this environment. The system thrives on volatility because volatility exhausts participants. Exhaustion leads to mistakes. People don't sell because logic tells them to. They sell because they want the discomfort to stop. That's one of the oldest tricks in markets, and it works best when narratives are confusing and contradictory. So we don't let narratives steer decisions. We let mechanics do the work, mechanics over mood. Watch this behavior carefully. When sharp selling appears near a level and price repeatedly returns to that same area, you're seeing a test. Historically, repeated selling often led to breakdowns, but recently, something has shifted. When price reclaims certain zones, it tends to hold them longer. That's not accidental. It suggests stronger participants are willing to defend higher ground. Not every time, not perfectly, but often enough to matter. And when that behavior appears during geopolitical stress, it isn't just speculative traders involved. It's hedgers, procurement teams, corporations protecting future input costs. The market would like you to believe this is just about silver, but watch the ripple. Copper responds, energy responds, rates shift, currencies twitch. These are connected systems. Silver is just the pipe that squeals first. So here's the takeaway that actually matters. We need to track policy language as closely as we track price action. We need to view Latin America not as emerging markets, but as strategic terrain. We need to treat Taiwan not as a distant headline, but as a variable shaping procurement decisions today. And we need to respect that in thin markets, small pushes become big events. If you want to stay ahead of the moments when the story actually changes, stay with these briefings. Because the next phase won't announce itself politely. It will show up as a minor headline, then hit the tape like a hammer. There's one development we're watching that could flip the entire risk map overnight. And it has nothing to do with silver's daily price. It's about who signs the next long-term contract and who ends up holding paper when access tightens. Yes, the Venezuela angle matters more than many admit. When access to discounted energy barrels gets squeezed, you're not just altering an oil chart. You're reshaping an entire industrial cost structure. That's why energy sanctions, shipping insurance rules, and secondary restrictions are never just legal language. They are economic torque. Now place that logic next to metals. If a country can't rely on stable energy inputs, it starts stockpiling what it can control: materials, concentrates, long-term mine output. That's why silver keeps surfacing in conversations where it doesn't seem to belong. Because silver sits at the intersection of electrification, defense, and electronics. One disruption, 3 industries feel it. Then there's the Gulf wildcard. People love to assume alliances are permanent. They're not. Incentives drive behavior. Security guarantees, financing, technology access, favorable pricing, those are the currencies of alignment. When incentives shift, nations reposition. They behave less like ideals and more like firms. They go where leverage exists. So here's the final signal to watch. If energy producers begin coordinating tighter supply at the same time metals policies harden, that isn't coincidence. That's choreography. And when choreography begins, the next headline won't read, "Silver is volatile." It will read, "Someone couldn't get delivery." That's the moment the broader crowd finally understands the difference between a chart and a shortage.